Hello, everyone, and welcome to another episode of the Perfect RIA podcast, What Works Wednesday edition. I'm your host, Matthew Jarvis, and with me, a special guest this week, the founder and CEO of Altrust. Yes, Altrust, the custodian, the little guy taking on Fidelity, Schwab, TD, and whoever else is left in that space. Jason Wenk, welcome to the show today.
Hey, it's a real pleasure to join you. Thanks for letting me join.
Now, Jason, I got to ask just right out of the gates, there's always this expression of taking on the 800-pound gorilla. But when I view like a Fidelity and a Schwab, this feels like the 8,000-pound gorilla. Like you're sort of taking on like some of the biggest institutions there is in the financial space.
I mean, look, yeah, they're big companies. I think, interestingly, I think it's a lot easier to go compete with a really heavy gorilla, right, than one that's a bit more nimble. So, the reality is that if something hasn't changed much in 20 or more years, 40 years in some cases, and the general net promoter score, meaning like advisor happiness with those platforms, is, I'd say, generally mediocre to low.
Yeah.
But the market size is absolutely gargantuan. Like, that's actually an entrepreneur's dream, right? Like, you're walking into like this huge addressable market where you've basically got a duopoly, two main companies controlling the majority of the share, and their customer base largely either, just okay or unhappy, right? Very few people are like raving fans going on to social media, like shouting from the rooftops, like how stoked they are about, a NIGO they got from their custodian and the 45 days it took to fix it, right? So I think that it's a lot of work. It's big, ambitious, and there's a certain amount of capital intensity to building custodians, but it's like literally the perfect kind of storm of opportunity. And then the timing couldn't, this is all luck, right? But couldn't have been better with TD Ameritrade getting bought by Schwab and kind of just creating a lot more, I think, anxiety, amongst advisors, kind of like not knowing what the future is going to hold, and they're losing some of the things they loved about maybe the custodian they chose. So it's been a fun run.
Yeah, that's pretty wild. So take us a step back. How did you get to the point where you identified this opportunity? Right. And like you said, it's sort of an entrepreneur's dream, but it's still an incredible amount of work, a lot of headwind. How did you get to the point where you said, hey, this is what I want to do. I want to launch my own custodian?
Yeah, I mean, so look, I think a lot of it's comes from a place of frustration as a user. So for those who don't know about my prior life, I formed 2 RIA firms. I built both of them from scratch to multiple billions in assets. Built the fastest growing RIA in the history of the entire industry, actually. So I know a thing or two about running an RIA firm and growing them large and doing it at scale. And so the thing that's interesting, right, if you're running a relatively small business as an advisor, custodial challenges are just kind of minor aches and pains, right? Like they're sort of like, the price of admission, if you will, like you just have to pay the toll, right? Yeah. And so it could be something as simple as like, hey, I only open 10 new accounts a year. So, hey, look, if it takes my assistant an hour or two to do it, so be it, right? You don't think that's that big of a deal. When you're in a large firm, right? So like my last company, a relatively normal month for us was like, maybe 2,000 new accounts or something like that.
Wow.
So all of a sudden, accounts that take a long time to open and to get ACATs done and to get authorizations tied to them, it's very painful. And then, once you're managing 50,000 plus accounts, rebalancing is really hard. And managing RMDs for 10,000 RMD eligible customers is hard. And doing, QCDs and other forms of cashiering, like all these things all of a sudden require armies of people because the technology is just really not there, right? It's still mostly driven around paper processes, at best using DocuSign. So you can Six Sigma your way to a certain level of efficiency. But at the end of the day, if you get big and successful, those small aches and pains are huge problems, right? They're like massive areas of friction.
Sure.
So that's really kind of how it happened. Ultimately, like the hair that broke the camel's back was, I'd say like around 2015 or so, I saw Robinhood take off, the consumer, stock trading app. And it just felt like a kick in the gut, to advisors, like where I was going, okay, a consumer, like let's say an 18-year-old could download this app on their phone, open an account in 30 seconds, connect it to their bank, put some money in there and be buying shares of stock commission-free in dollar denominations. Like they could be like, hey, I want to buy $5 worth of Amazon or something, right? And they could do it. Meanwhile, advisors, we still had to do mountains of paperwork, even if it was digital PDFs. It still took forever, super cumbersome. At that time, we were still paying commissions. Like it was really unpleasant. And at that point, I was like, okay, I've been trying to build, I had my own good size, I had a 30-person engineering team at my old company. So we built a lot of our own tech and we really took it as far as you could. But at that point, I was like, I can either complain and try to build like middleware to make these really crappy custodial experiences better, or I can just build the whole stack, right? Build the actual custodian and integrate all the software. So that's really where it started, right? It was just, again, born of the frustration of being an advisor.
Yeah, I do, now that you recount the Robinhood thing, right? I remember having that discussion several times. Like, wait a second, somebody can fully onboard in an hour and we need days or weeks and multiple signatures and the documents bounce back and this is all in one succinct place. So yeah, I could definitely see that as a major driver. By the way, for those that aren't in the industry, like that hasn't changed outside of maybe an Altrust, right? That's 5 years ago. It's not as though Fidelity and Schwab have suddenly figured that out. At least not on the advisor side.
100%. Yeah, that's the great irony, right? Is that like you could open your own brokerage account on the internet at like Ameritrade in 2005, but you still can't do it in 2023. I mean, it's actually crazy. And there's a whole bunch of reasons they'll tell you why, but I think at the end of the day, nobody had ever built a custodian for advisors, right? Like these existing custodians are just sort of retrofit consumer solutions to meet a need. They've turned into like really big businesses now. But you're trying to get technology that wasn't designed to be intermediated with advisors and their staff and their compliance people, right? And so that's why there's so many software tools that are required to make a custodian sort of serviceable. So you have all of these like performance reporting and trading, rebalancing, fee billing, portals, right? All that stuff. It really only exists because if you think about it, like if you're building this from scratch, most of that would just be built into custodian, but they didn't have that because that wasn't their core business.
Yeah, for sure. I know we custody at Fidelity, and one of my biggest beefs is always that the advisor portal for clients is the same as the Fidelity retail portal, right? So when my clients log in, it says in the corner, your advisor, Matthew Jarvis, and in much bigger fonts, it says, if you'd like a second opinion from a Fidelity retail guy, like click here. And I always say like, hey, why won't you guys turn this off? But Jason, to your point, it's like the RIA custody side is like an afterthought for these major custodians. So with Altrust, I just said my biggest question, and the question I hear from a lot of advisors is, can we trust I want to call it no name. I don't mean any disrespect for that. Like we're used to like seeing Fidelity and Schwab on the side of stadiums and sponsoring everything, and Altrust is this new up and comer. Like there can be this thought of like, hey, can I trust the new guy, for lack of a better phrase? And I don't mean that with any disrespect. Like that's just the question that I hear, that I ask myself. So and you must run into that. Like how do you address that?
Yeah, I think it's the same way an advisor would answer that same question. Why should I trust, your small RIA firm when I could have my money at Goldman Sachs, right? Yeah, and so the same things you'd say, which is like, look, you're hiring the advisor first and foremost, not the firm they work for. That's where the relationship is. Trust that person. In terms of safety, I think, advisors might need a little bit of education perhaps, but custodians, especially if you're a monoline custodian, meaning like your only business is custody, is one of the safest businesses in the world, right? Because customer accounts are segregated. They're not on the corporate balance sheet. Yeah. Securities are held in the actual street name of the customer. So in the worst possible world, right? Lehman Brothers, Bear Stearns, those companies go out of business. All their brokerage account customers were totally fine, right? Because those assets were not on the balance sheet of the actual custodian. So I think that's one thing. I think the other part is like, obviously we have the SIPC insurance. We have the exact same Lloyd's of London insurance that Fidelity has, for example, like literally the same carrier, same dollar amount. So every single protection someone has at Fidelity is the exact same as it is at Altrust. In some respects, what's cool about Altrust is that we don't have any other competing businesses. So in today's market, right, 2023, there's a bunch of people really worried about banks and bank failures. Listen, if your custodian is running a bank and their bank balance sheet has got a lot of like, non-mark-to-market, daily mark-to-market shares. In other words, they've done like mark-to-maturity accounting. Yes. I just listened to a podcast this morning that was talking about the San Francisco commercial real estate market. Today they have 30% vacancies. There's a prominent building in the financial district that that most recently sold for $350 million. It's being marketed today for $60 million. I
saw that.
Because of like
pennies on the
declines,
dollar,
right? And prices. I wouldn't want to be involved with a custodian that actually has a big banking relationship attached to it. And without naming names, most of us can actually figure out there's a couple pretty big banks that own pretty big custodians. So in many respects, I think like, we're in a really cool spot. We don't have any balance sheet risk whatsoever. We have no debt. We've got a substantial amount of cash. So there's kind of, I think, a lot of things that if an advisor does a little bit of homework, they'll find like, wow, actually, there's no increased risk. In fact, there's a chance it's lower risk because we don't have those strange banking exposures that some of the other custodians might have.
Yeah, those are some great examples. In fact, some great correlates, right? Like if I'm working with an independent RA versus working with the Merrill Lynch, right? You're looking for the big name versus not. But I loved how you hit it right on the head, right? The securities are held in the street name. They're in the name of the client, and you don't have those other risks at play. How about when advisors look and so they're looking at pricing, right? So it's not, price gets put out of place, right? And so a lot of advisors, and this, Jason, they don't understand how Fidelity and Schwab really make their money, right? They have this illusion like, well, everything's free there. Like, well, they're not putting their name on stadiums with free. How do you help advisors when you're talking to them about Altrust or Fidelity or Schwab or whoever to really understand like, hey, there's more going on here than just the ticket charge or just the basis points of the fee to be on the platform?
Yeah, I mean, I think look, the best proxy for people to understand the custody business is because Schwab's a public company. Just look at Schwab's financials, right? Their Q1 earnings came out recently, and I think they made their revenue was $550 billion or something like that, or whatever. It's like some absurd number, maybe 550 million, excuse me, I think is what it was. But suffice to say, like when you look at their revenue. Or maybe it was 5.5 billion. Okay, here, let me get this right. In that neighborhood.
It was a big number, yeah.
Half of all of that was made off cash, right? And if you're an advisor and you're using Schwab as an example, that their default sweep vehicle pays the customer like 40 or 50 basis points in a world where the effective Fed funds rate is close to 5.
Yeah.
So what's happening for like a traditional custodian is like they, because they make so much money off cash, they have a really strong impetus to make sure your customers have lots of cash in their accounts, right? So how do they do that?
That's a great point.
Maybe they don't allow fractional shares, right? So if you don't have fractional shares at your custodian, this means you have to have more money in cash than what you'd otherwise need, right? You can't just set a percentage like, keep me at 0.25% in cash, right? Some super de minimis amount. Instead, it's going to be always rounded up because of these whole shares. The other thing that you'll find is that there's only one security type that trades with fractional shares, that is open-end mutual funds. So if you happen to have an account that you do want to have, again, some percentage-based precision, it's going to be mutual funds versus ETFs or equities. Individual equities will be very hard for almost any client unless they have very, very large account size. So that means that you're going to always be paying higher internal expense ratios. Even if you're using low-cost ETFs, you're still paying something for those, right? So every incentive they've created, without really telling you about it, is to make sure you either have money in packaged products that they get paid 12B1s or some revenue share on, or in cash more than what they need, right? So these are some of the ways that you think about like the cost of doing business. This reminds me of like basic business 101, like think about like opportunity cost. Opportunity cost isn't a real boring cost. It's sort of like, hey, if I make a change, I might miss out on something I'm used to having. I think that's the biggest cost people have when they choose a traditional custodian, is that they don't even realize it, but they're actually costing their clients lost returns. So your clients are making less money at a major custodian than if they're with Altrust. And the advisor is going to absolutely be paying more in expenses, right? They're going to have to buy software that they otherwise don't really need, and they're going to have to spend a lot of time on doing things, or their staff will, that they really don't need to do. This could be simple things like account opening, or it could be things that are a bit more like advanced, like cash management, trading, rebalancing, tax loss harvesting. These are all things that, like, in a frictionless world, we would all say the right thing to do for clients is to keep their money as fully invested at all times. We should every day look for opportunities to do tax loss harvesting. We should do advanced planning and ideate kind of ways to kind of keep their internal expenses low. All of these things are things we know we should do. It's very hard to do them. And unless you go buy external software, in which case even a lot of that's not all that great, it's hard to even do it, period, right? So these are things, when we think about cost, right? Yes, there's the actual revenue that a custodian makes, in which case that creates a lot of strange biases, right, for how they might develop their product roadmap. And then there's these sort of like non-obvious costs, which are actually like these opportunity costs where you and your clients are just spending more time doing silly stuff, that you don't need to be doing because of, cumbersome, human-driven kind of processes. So I hope that gives like some people like an idea of like, what's the whole rub here with custody? I think the other thing that is really, really key is the user experience. So regardless of cost, like it's a pretty non-good experience to have to do everything via paper and wait weeks and not really know the status of a transfer. If I need money from my account, if there's not like a form on file already, I have to like attach a voided check and all this nonsense. I mean, these are just non-elegant user experiences. And actually, none of the consumer apps have that, right? So if a client just had like whatever, SoFi, Robinhood, Betterment, Wealthfront, Personal Capital, et cetera, like they all have none of that nonsense. But so many advisors, like we just sort of like accept it because that's the way it's always been.
Yeah. So a couple interesting things come to mind. It's almost, and again, as advisors, we're human. We're guilty of all the same cognitive biases as our clients. But it almost is like if you're looking at custodians, right? If you're, just to be simplistic here, if you're looking at Altrust versus Fidelity versus Schwab or LPL, whomever, right? Our minds are drawn to, hey, what's the ticket charge or what's the basis point? But Jason, to your point, it's really spreadsheet that out. Okay, so let's say that on that basis alone, Fidelity's $2 cheaper, but then I have to pay $30,000 a year for Orion, and I've got to pay a team member $60,000 a year to do the rebalancing, and I've got to send every client 5 extra emails, right, to really put that on the balance sheet and look at the full cost. Shortly before we recorded this episode, I recorded an episode with Louis Diamond from Diamond Associates, and they help do consulting for advisors thinking about leaving BDs and wires. And we were talking all about like, let's really map out this balance sheet of what am I really paying on all these sources and what am I really getting on the other side. And I guess I would have never thought of, all right, well, how much is this going to cost me in client relationship capital if I have to send 4 emails every time they want to take a distribution versus, and that's not even hyperbole, right? Versus they can just go in the app and click the button. So I think that's an interesting insight you bring to this of, whereas the other custodians, their business model is like, don't look at the man behind the curtain. You're kind of saying, look at everything behind the curtain. In fact, tear down the curtain. Let's get all the numbers on the table.
Yeah, look, I mean, I think like, I'm a pretty big believer in like an optimizing, kind of lifetime, business, et cetera. I think, I've listened to some of your shows. I think you are too. I think it's a big part of like, kind of like your kind of, method of operating. So I find it ironic, right, that people sort of like don't do that with their custodian. But to me, it's like if you're going to, try to find like the most productive way to invest all of your capital, both your time and your money capital, people should probably audit, how much work is going in, and also like what are they getting for it. So it's not just like the time and the cost, but like, okay, really, what are you delivering? Is it even like good? And I think that if they did that, they might be less inclined to use a custodian who's buying, stadium rights, and buying golf tournament rights and stuff. Like that's a really terrible use of capital for advisors anyway. And all of those things actually increase the COGS, of their product. And in many ways, because they're not spending on R&D, it creates a higher OPEX. So all of that gets passed on to the advisor and the advisor's client. And that's either going to be cumbersome manual workflows, processes, et cetera, or just literally an inferior product that creates less returns, for the client because they have to make sure they generate enough revenue to both pay for all the COGS, right, all the costs of goods sold, and all of the inferior OPEX due to lower R&D spend. So most people don't really dig deep, but if they really, really want to get optimal, they'd find that there's definitely better ways to do it.
Jason, how do you, when you're talking to an advisor, or I guess when your team is talking to an advisor and they're looking at migrating away from an existing custodian into Altrust, and by the way, I think this is the same thing we run into an advisor if we're trying to encourage a client to move money from an old 401k plan or another advisor, right? There's this, and I forget the term for it, right? We're really anchored where we are. We're like, hey, I know what I've got, and maybe it's not a good deal, and maybe I don't agree that they're buying golf course rights and that they're not paying me anything on cash, but moving is such a pain, right? Moving seems like so much work. How do you at Altrust address that? And for our listeners, I want to really highlight, like we all run into the same thing. Wherever I'm at, no matter how painful, feels more comfortable than moving.
Sure.
Right?
Yeah, I think you know that, like me, that kind of anchoring is very much the case. But so interestingly, I think, this is part of, I think it's a narrative the industry created because they want you to feel that way. When the reality is like, and you'll see, like if you go to our website, you'll see testimonials from advisors all the time, which by the way, we never ask for them and we never pay anybody for them. Like these just happen. People just go on social, whatever, and they talk about like their experience. But some of them that I find are really cool is like there's people who are like, hey, listen, I moved $100 million to Altrust. It was super easy and painless, and did it in whatever a matter of days or weeks. So what's interesting is if you remove all of the paper from the process, what you'll find is, like, for example, opening an account at Altrust, a single account, right, is going to be a less than 2-minute exercise. Doing the ACAT is instant, meaning like you don't have to upload paperwork or documents. Like you just literally type in an account number and hit submit. The client gets an email, they hit OK, it goes directly to the DTCC, and the money shows up in 3 to 5 business days. I mean, like, this stuff doesn't have to be hard. Like, we've made it hard, and it reminds me a lot of, like, there was a Netflix documentary years ago. It was called Who Killed the Electric Car?
Oh, yeah.
And basically the documentary was talking about how, like, there were really good high efficacy electric cars 30 years ago. But, what they found was that those electric cars didn't need a whole lot of service. So the dealerships couldn't really make any money on the back end. And they also didn't use any fuel, so that's kind of like bad for like the oil and gas industry. They weren't real happy with automotive manufacturers because of that. And then there's all the commerce associated with like fuel stops and et cetera. Well, that was kind of not necessary. So there's this whole like kind of like it's a bit of like a I think like a I don't know if it's a witch hunt or speculation, right? Whatever. But the point of the documentary was sort of like, hey, listen. We think that there might have been a coup of sorts here, where it's like, a bunch of different kind of related parties that didn't want these things to take off, got together and convinced General Motors to shut it down, right? And so that was the case. Tesla comes out, right? And now all of a sudden everyone's racing to catch up because it turns out the electric car was a pretty good idea, and all that disruption is net positive, to consumers. It's much better user experience. It's a delightful experience of like ownership where you don't have to like go to service centers and do anything. And, deal with car dealerships and the salesmen and all this other nonsense, right? That was all part of this big old legacy way of doing things. Our industry is much the same, but again, like if an advisor wanted to move their whole book of business to Altrust, it's really a matter of a few clicks. It's not actually like a cumbersome process. There's no paper, there's no anything. It's really, really, really quite easy and simple. And that's because we just reinvented like how it should be. Like, right, this is your data and your client's data. It shouldn't be a hostage situation. And it shouldn't be this big, painful, scary thing. So I think once people realize that's the case, again, eventually what you'll find is all the others will start trying to play catch up, because advisors that use Altrust will talk about how like crazy easy it is to go from like all, huge amount, thousands of accounts at one place, move thousands of accounts over and really not have a whole lot of that. Again, friction, pain, anxiety, stress, frustration. And clients the same way. Clients will be like, wow, I couldn't believe how easy that was, right? So just, I think food for thought. It's hard for people to appreciate that unless they've experienced it. And in our industry for like the last 20, 30 years has created a narrative of that it's so hard to change. The sort of like, inertia is really the competition, because no one wants to actually change. That'll be different in a few years, I suspect, for sure.
I love that. No, that's a great point. And of course, this podcast is about taking action, and I really appreciate the insights that you've shared there. But I really like this idea of let's step back and I was just doing it myself, right? Which like industry mantras am I repeating without even stopping to think of it, right? Hey, if you want to change custodians, it will be this insane amount of work. It will set you back months. Well, where did that come from? Like that's not objectively true, right? That's a mantra that we've all, whether it was sort of a conspiracy or just we all sort of evolved into that, because like you said, it is a bad product. That's an interesting one to do. So I would say that's definitely action item number one. Like, what mantras am I repeating that aren't necessarily true? And then the second one, Jason, that you mentioned in my mind would be, what are you really paying to be at your current custodian? Not the ticket charges, but everything else, the spread on the cash, the amount of cash, the hassle, the number of emails your team has to go to. The thing I mentioned, that when my clients log in, they're getting an advertisement for Fidelity Retail, which hasn't ever been an issue, but it still bothers me. Like, all of those things have a price, and we've got to add those up when we are comparing these things.
Totally.
Jason, any other action items that come to mind for you, or how can people learn more about Altrust if they're saying, hey, listen, I want to see what the other side of this narrative is?
Yeah, I mean, like, I think altrust.com is a great place to start. We've really tried to craft our entire web presence to be actually just geared towards advisors, so they can kind of do some of that like mental math and kind of see like, okay, what does the grass look like over on this side? I think they'll find that there's a number of narratives that all of a sudden will start to kind of become very apparent, and people will go, wait a minute, why isn't my fee billing built directly into my custodian? Like, think about this as a really strange thing. Why would this is so weird that the custodian has all the data, but you can't just like put your fee schedule and attach it to the account. Instead, they want you to port the data to another system. They're going to not make it easy. It's going to be this really gargantuan flat file. So some other software company will have to reconcile it. They may not even get it right. Like they make mistakes all the time on reconciling all the data, transactions, corporate actions. So then that company can calculate the fee to create another file that by the time you then upload it to your custodial platform, a whole bunch of stuff will change. It could be 3, 4, 5 business days later. So the client may not have enough cash. And so they go to debit the fees from the client accounts, and then you get 5% rejects because the client had something happen and there's not enough cash. Now you got to manually fix it, right? Like stuff like that is the craziest stuff. Like, how did we get here, right? Yeah. And so what people will find when they check out Altrust is like, there's a bunch of stuff that you'd go, that makes no sense the way we've been doing this for like the last 30 years. This is literally completely crazy that we still accept that to be like the norm. And there's a bunch of those things, right? Those will help people with like that sort of time audit and money audit. And I think it's like actually pretty remarkable how much money we estimate, like for people in true hard costs, it's like 70 to 90% cheaper to use Altrust than other platforms and software costs. And labor costs go down by 65% because so many things are automated. You don't need to pay a bunch for labor costs. So there's a ton of money savings there. The other calculus, right, that I think is really important is to go, how much better would my clients be off? And this is an interesting one because, better client outcomes creates more, better returns for the clients, which creates more loyalty, which creates like higher likelihood of referral. Like, so there's all of these crazy things you could kind of go, wow, the long tail of this is that over the course of the next decade plus I'm building my business, I could presumably create tens of millions of dollars of enterprise value simply by having a better custodian. Like this is kind of crazy that like we haven't really done that type of kind of business math. Really simple stuff. You can do it on a napkin. It's not hard and complex. But I think check out Altrust. If you're welcome to follow us on social, we do a little podcast as well. It's called The Advisor Journey, and really proud of that because we try to profile really like forward-thinking advisors. One of the things that's always bothered me about the industry is that like we have this, I think, false sort of like notion that in order to be successful, we have to be like super big and manage billions of dollars. And admittedly, like I built 2 multi-billion-dollar firms. Like, I fell into that trap. But what I find so cool and so refreshing about our customers and the guests we have on our podcast is like, they're doing things totally different. Like they're actually taking the whole industry, kind of spinning it on its head. Like people are building entirely different compensation kind of profiles of how they get paid by their customers. They're going after very underserved demographics.
Sure.
A lot of this is actually made possible because like of the software and technology. It frees up so much time and gives them such better margins that they can serve people they could. And so check out that podcast. It's a lot of fun because you kind of hear these stories of like, okay, they might seem different than how you and I might do things, but like there's some people out there, if you're open-minded, they're doing things in a way that, who knows, it could become the new industry standard in another decade plus. And I think we should be open-minded to kind of learning. The last thing I want to be is like, hit my 40s and have, which I'm now in my 40s, and have all these weird biases, right? That like, I'm like, oh, this is the way because I did it this way. It has to be done this way. It's really, really fun for me to kind of see like how like the next gen of advisors are building really cool businesses that I would have never thought of myself. So definitely check out the website and check out the podcast. It's a good way to learn a little bit more about how we think and do things and see the world.
Yeah, I love that. And that's one of my big draws to going to events that are outside the industry, right? Like Genius Network with Joe Polish or Strategic Coach with Dan Sullivan or any of these where, like you said, how is somebody doing it different? Like if I just surround myself by people that are doing it my same way, or in the case of our discussion, with people that are on the same custodian, the same legacy custodians, I'm going to hear the same things again and again, and I'm not going to see a bigger vision. Well, Jason, thank you so much for coming on the podcast and for your work disrupting the industry, right? Like you said, disruption, innovation is always good on the net, so appreciate that. And for all of our listeners, until next time, happy planning.
Thanks.